Hi there, and welcome to this month's edition of On Track. So much going on. I'm recording this on the 26th of May, and I'll have all the performance numbers up to the end of April and all the news right up to the minute. And as I say, there is so much going on. Before I get into it, as always, this presentation is prepared for clients at McGregor Wealth Management, and in particular those that use our care investment process. For everyone else, feel free to enjoy this, but please do not act on anything without seeking advice that's relevant to your own circumstances. We're going to have a look at the economic news as it's coming through at the moment. We've still got a lot of focus on what's happening in Iran. In Australia, we've had a budget announcement, so lots of debate going there. And the markets have been surprisingly resilient. And in fact, when I look at performance numbers over the last 12 months to date, they're almost bang on budget, despite it being a rocky road. And we'll get it all in perspective as well. So looking at the cash rates, we've seen that go up. So the RBA cash rate now 4.35. There is a high probability the markets are factoring in one more rate increase, although every now and then, depending on the economic news, they think maybe that won't happen, but it certainly is possible. On the other side of that is probably some drops, all being driven by, and as I go through the news highlights, the Iran war. Is it over? Is it on again? Is it off again? This morning, the news looks positive. I've put down the bottom of this page a chart of Brent crude oil. So you can see Brent crude oil cruising along sub $70 pre the Iran war, then bang, all the way up over 110. We thought it was easing, it dropped down to $90, then on again, off again, back up, back down. So even though share markets are looking through the war at the moment, so share markets, particularly in the US, are very strong, particularly driven by tech. So it is very much focused on tech. But if you look at the S&P 500 or NASDAQ, they're all at new highs. Australia is much weaker. We don't have that same tech influence, so it's still showing a bit of weakness. We'll talk through that shortly. But yeah, the share markets, ironically, are looking through, whereas the oil markets are still high, although overnight they did drop substantially below $100 again. So that means right now the markets think, all right, maybe this time they'll do a deal about opening up the Straits of Hormuz, and that would, of course, get oil flowing around the world again. Oil prices up leads to inflation. Inflation expectations leads to interest rates going up, and yeah, you're going to have this conversation. I will repeat myself here, but it's exactly the same as post-COVID. Yes, we've now got inflation. Will it be transitory, or will it find its way into the system? So we're going to repeat that conversation. In the budget, which came out last week, I should say, Treasury have forecast inflation going to about 4.5%, 5%, and if the war was sustained, it might go up to 7%. It looks like the war will resolve, so we'll probably see inflation peak at 4.5%. It will probably be stubborn, but certainly that's not crazy levels, and should be transitory. In fact, Treasury forecast inflation back in the 2 to 3% band within 2 years. So we'll see. They kind of always do that because they assume it's always being corrected, but we'll see. The higher interest rates are absolutely taking its toll on mortgage holders. The property market is a little bit flat at the moment. More about that later. And obviously it's got the impact of the budget as well. Profit numbers in the US are good. And a spoiler alert, we've dropped our dial to 9, largely off the back of increasing profit numbers. So even though market's up a little, the fact that profits are validating that says that the market is less overvalued than we had previously. So we've got the markets a little bit expensive, but not crazy overvalued. Yeah, and big changes announced in the budget. Big but not big, and I'll talk through them at the back end. I've got 4 extra slides in this presentation. So at the back end of this, I'll walk through the big budget changes that affect investors. And it's around trusts, it's around negative gearing and CGT. So hold that thought, I'll go into that. So just checking through the rest of the numbers, 90-day bank bill still paying well for those that have got savings. They're getting good dollars again at the moment. 10-year government bond yields very high in Australia at 5%. Pre-Hormuz levels, they were down closer to 4.5. In the States, they're about 4.5, but they were sub 4 pre-Iran. US cash rates, also there was a little jump there. They're potentially forecasting another one, but you've got conflicting pressures there. The Trump administration is putting pressure on. We get a new governor soon, so there'll be pressure to drop rates, but they've got a little bit of inflation as well. But that's why there's so much pressure on Trump to end this war. The two big pressures: lower interest rates and lower petrol prices. He has the midterms coming up. Not him specifically, but the Republicans and the whole of the US political scene. Midterm elections in November, where if things are against a government, that can lead they may lose control of the houses, which means they can't get much done. Some people might argue that's a good thing, but it does lead to lots of nothing. Aussie dollar still remains strong, and that's meant that the returns that we get from overseas shares have been handbraked a bit, although we, in our care process, have plenty of hedged shares, which enjoy the full uplift when that's there. You can see those Aussie numbers. We're waiting for some inflation as we speak, but we're 3.5 and expect that to go to 4.2. US numbers about 3.8. Mortgage rates pretty stable, but obviously whenever we get a jump in the cash rate, they jump up by the same amount, so all up 0.25. Lowest variable rate we can see still got a 5 in it, but mostly what we're seeing around the place is about 6.1 to 6.25. Macquarie is showing 6.19, but you can get 5.35 on a term deposit. So for those with savings, really decent rates. Let's have a look at the portfolio returns. And as I said, the dial we've dropped to a 9, so it's just a little bit expensive, but nothing to stop anything. These returns at the end of April. And I always glance down at the 10-year returns and go, yep, exactly as the way we planned, slightly better. Then I come back and go 7 years good, 5 years good, 3 years good, 1 year good, a little bit of negatives in the 3 to 6 months. But rock solid and consistent. That allows us to plan well. And let's jump to our wall of worry. And you can see, the downturn from the war, massive recovery, down again a bit. And this is Australia, it's bouncing. If we're looking at a US chart, and we will later in the segment, it's recovered fully, but Australia is still well under that pre-war high. And once again, so that downturn in Australia looks like it's going to be about 7 to 9%, which is far less than anything that would count as less than anything that would count as a correction, and less than these bumps we talk about in the wall of worry. So it hasn't been a huge share market issue, although it feels like it. And I think it feels like it because of the effect it's having on oil prices and price of petrol at the pump and inflationary talk. So the news feels bigger. I should say the media likes these type of things because it can make it feel really big, but it hasn't been too bad at all for investors. Bond yields, you can see there, the blue line, firmly at the top, which is almost just above where it was a month ago, but at the high end of the last 12 months. So before all this came along, bond rates were looking like they were going down, and then we had them sneak up, and the wars exaggerated that as well. And you can see in Australia, 5%. We were sneaking up, and that was because we hadn't contained inflation. We were starting to talk about interest rate rises, but in the States, it was actually coming down until we had this boost, post the Iran war, and very sticky up there, about 4.5%. You would expect if the war starts to resolve, this will start to drop. We will see. Time will tell. In the exciting life, boring money section, another super disaster. They just keep coming. It's quite scary. This is from the Financial Review from John Wesselev, and this is last year, but this is just coming to light now. But this was 160 mil super collapse. No one checked. They were cowboys. So this was the third. We'd had stuff from Guardian, First Guardian and Shield, and this one was the third one, which was, but once again, the same story. People getting cold called about their super, promised high returns, a little bit naive in my opinion, and then they switched their super with hardly any any significant advice, just on the promise of high returns. And eventually that went into Australian fiduciaries. Yeah, it looks like, and what these companies are doing, they're promising high returns. They're setting up highly risky investment vehicles with lots of lending and other stuff with related parties. And ASIC, taking these guys to court as well. So just another way that people are losing their money. For those of you who are clients of ours, you know the process to come through over 3 meetings, lots of due diligence, lots of public accountability. Unfortunately, there's people out there who are too quick to move their super off a bit of telemarketing, chasing high returns. I've left this in because I like sometimes to leave some slides in for a few months just to reiterate. But the sheer, I'm always in amazement. I've been looking at these types of numbers and statistics for over 30 years now, and you would think we'd get smarter, but we don't. So we know that active funds, so this is firstly, when I look at these colourful charts on the right, we can see global equity and Australia are the first 2 categories. And you can see that over 15 years, 96% of international active managed funds fail to outperform the index. For Australia, it's not much better at 87%. Incredibly low odds. And it's quite sad. But the main reason they fail to outperform is just costs. So the modern world, this is why we use low cost index funds. They will absolutely perform in line with the market, as opposed to underperforming. So a timely reminder. In updating this, no real changes. So when we look at the tailwinds, the recovery that we've seen in the last month is because that global growth AI story has come back to the fore, and the geopolitical noise has stepped back. So picture a tug of war between the geopolitical noise around Iran and oil prices and inflation as the headwind, but the tailwind is profits are actually growing. Huge amounts of money are being spent in the AI super cycle. Record profits from NVIDIA during the month. And they're making real money selling the chips. Now, the chips are being used to build the AI systems, so we're not seeing that completely filter down into broader company profits, but overall company profit forecasts are set to go up, which is obviously the biggest tailwind that share markets can have. So there's I've highlighted in red the things that aren't turning out as planned. So we expected at the start of the year interest rates to be easing. They're going up because of the energy crisis in Iran and the Straits of Hormuz. That's also linked into sticky inflation and the geopolitical noise. But the tailwind of the growth, the AI, etc., strong corporate balance sheets, governments spending too loosely, which is bad for the governments and other things, but good for share markets. They all continue. And so some of those black swans have come into being. A black swan is an unexpected potential event. The central banks are now back into rate hikes. That was a potential black swan we named at the start of the year, and we've had the geopolitical shock, which was Iran. Once again, the key strategy here is diversification, avoiding single themes that can be smashed by some of these things, and always having some powder dry for liquidity and potential opportunity, and keep a long-term focus when all the world is trying to focus you on the short term. Keep that focus on your plan and the long-term investment strategy. Like I said, we're at 9 here. I won't go into that too much. I want to save some time for the budget announcements. So we've dropped that back 1. So still a bit expensive, but not quite as much. And that was for 2 reasons. Even though the markets had gone up, the Australian market has gone down a little bit, so that helps. But in the US, we've seen profits elevate. So I'm just going to pause briefly here in the mess it up section. But once again, short-term focus, extremely dangerous. And right now, I've never seen so much short-term focus. I shouldn't say that. We get it all the time. So we've often seen it, and it never ceases to not surprise. So longer-term view, essential. Same with, hand in hand with that recency bias. And recency bias, just to explain again, and I do rotate through these are important in the way they come alive. We had an investment committee meeting last Thursday down the Gold Coast. We take our investment committee on the road twice a year, so advisors from those areas can attend. Our investment committee is completely open to advisors, so they feel like they've got a seat at the table. We've got a very transparent process. We had 20 people sitting around that table as we went through our normal meeting. We would normally go through all our stuff, plus have 2 or 3 guests from investment specialists and funds that we use or we might consider using to give us views on all sorts of things. And yeah, we just back to the behavioral biases. We make sure we call ourselves out on our own behavioral biases. And the one that's the most dangerous for everyone at the moment, including professionals like us, is this recency bias, which says that current news, we tend to think it's way more important than it is relative to history and events in the long run. So always worth thinking about, is this really any different? Is this just another one of those? Another one of those, in this case being a war with an energy spike. This too shall pass. And as I've told lots of you, wars are generally, almost always, positive for the economy. Now, I don't mean to diminish the tragedies that wars bring out, but for the economy, what happens in a war, they blow up lots of property. That's got to be rebuilt. That's positive for GDP and for economic growth. They blow up lots of bombs and stuff. They've got to be restocked and rebuilt, and that's also positive for GDP. So while being tragic for the human consequence and everything that goes wrong in a war, they're actually positive for GDP. And share markets always end up higher after a war than they were at the start. And often there's a little dip at the start, but then they get back to their track. I just want to repeat, in all our pillars here, the focus on diversification, it is simply the most powerful thing to prevent volatility, which prevents bad investment behavior. And my definition of diversification, just to repeat it, is bargaining away the right to make a killing in return for never being killed. So a simple way of saying you might not be swinging for the fences, but base hits get you there in the long run. And there's always something happening. And when I go through the returns, you'll see that. So Aussie shares, in spite of all this, is still printed a 10% year, almost 10% over 3 years, 8%, 5, 9. So very consistent. Slower growth than overseas, but still rock solid and a key part of the portfolio. And of course, the franking credits that comes with that, extremely valuable as well. But you can see here on the chart on the top right, the Aussie market has not got anywhere near its previous highs. Now, US shares, and this is in Australian dollars. So this chart is VTS. So it's one we hold, but it's effectively the S&P 500, but in Aussie dollars. So it is practically almost at the pre-war highs. If you look at the S&P 500, it's way above its highs. The difference is the Aussie dollar, because while this has gone up since the war bottoms, so has the Aussie dollar from 69 cents to 72 cents. So that acts as a handbrake on our view of the world. Same with the global leaders, same story. It has slightly passed its peak, but if you were to look at NASDAQ, for instance, it's way above its peak. So once again, the share market is looking through the war. They're assuming it's going to be over. Bond markets and energy markets are still cautious, although this morning, as I said, energy markets, Brent crude dropped below $100 again. So, and if we do see a resolution that the world believes is going to stick, we will see slowly oil prices retreat back to the levels they were. Now, that might take a few months. It depends how quickly ships can start delivering. But keep in mind, markets are always forward-looking. Once they know supply is going to be reset, prices will start to drop. How long that takes to get through to the Bowser prices, don't ask me, better brains in the media on that, but we will see drops in that over time, which is good. So global leaders, 26% the last year, once again, driven by that Magnificent Seven. Look in the top 10 holdings for IOO. NVIDIA, 13.4%. So NVIDIA has become that massive company, surpassing what was the Magnificent Seven: Apple, Microsoft, Amazon, Google, etc. So phenomenal returns coming out of that tech spot. You'll see US small caps are back up again, which is good. 23% for the year, 5% for the month. They had lagged. You'll see the 5-year return there at about 7.34%, but they seem to be coming back. Once again, pointing out the benefit of diversification. All these things have their day and they trade back and forward slightly differently over time. We rebalance on a regular basis, which means when something's had a good run, we'll take a little bit of profits, put it into something that hasn't been so good. And often the things that haven't been so good, like emerging markets in this slide, were terrible for the last 5 years, but have been super strong now in the last year in particular and the year before. So we've been steadily buying those as part of our rebalancing process for the previous years, and now get to profit on that to the point where we sell some to, say, in this case, buy Aussie shares. So we did rebalance for some of those in the last 2 months. We look at the rebalancing every month. We don't always act on it, but we do when there's been enough of a move to make it valuable. Gold down for the month, and it's still hovering. Gold went so hard, it's really been taking a breather, and there's been a bit of profit taking, and we'll see. We're still very favorable gold in the long run as it acts as a currency in a world where the US dollar will probably show some weakness due to their large debt levels. Let's jump into property, and then once again, I will go through the key budget changes. Property, no real change in the headwinds, but we've now got interest rates going up. Nothing in this budget massively changes the undersupply. The government's talking about it. There's a few little initiatives in there. What they are saying, with the focus for negative gearing now being on new builds only going forward, that's the same as depreciation as well. So that should lead to a supply response in that the market will go out there and new builds will become more attractive to investors. So we'll see if that comes to be, and hopefully it will, because that will help the supply issue that has meant prices up there. I'll go through the growth in a minute. So there we go. The last 12 months across the board in Australia, 9.8%. It's starting to moderate. We're seeing that flattening. If you look at the curve down the bottom, you're seeing a flattening there. And once again, a large variety. You see Perth as high as 26%, Brisbane 19.7, Darwin 19.6, Adelaide 12.2, Hobart 8.5, Canberra 5.6, Sydney 4.2, and the poor old Melbourne at 2%. Melbourne has lagged, and that's partly economics of that state. They have a lot of debt. They were hit the hardest by COVID and haven't really recovered from a property price point of view, while everything else went crazy. There's the rates, both the fixed rates and the variable rates at the moment. Like I said, the average rates, the headline rates for the banks are now in that low sixes. There's nothing particularly attractive on the fixed rates. They're all kind of the same at the moment, low to mid sixes. So once again, two reasons to lock into fixed rates. One is if you thought rates were going higher. It's always hard to get that thinking right. And even for professionals, interest rates are notoriously hard to predict. The second reason you have fixed rates is to lock in your payments. If you're buying a property or something and you just want to know what the payments are so you can budget for it and not be worried about major changes. Long-term fixed rates, you can see they're mid sixes to slightly higher than that, but call it 6.5%. You can lock in a 5-year rate. So for some people, that approach is if the property numbers work there and you're buying for growth, lock in the rates so you can fix your allocation on your cash flow. Not much change in the property clock. You'll still see places everywhere in the cycle. We've got the performance property chart on the left showing that Sunshine Coast, where I'm speaking from, is kind of at the peak of its selling window. Whether it goes down or not remains to be seen. We're seeing corrections across Sydney and lots of New South Wales, a little bit of Tassie, but mainly New South Wales. They're not big corrections, but they're still corrections. That just means sideways or down. And you're seeing Victoria come into the value area and still in momentum. North Queensland in particular, Perth and Darwin are the ones that are riding quick at the moment. You'll see that in the same numbers in the Heron top white chart on the right. You'll see a cluster of things in a rising market. And some at the peak and some declining. They're different views. They do these things differently. We like both. No one can tell us exactly what's going to happen in property, so we like having lots of data, and we do rely on these to form our broader approach in investing, which is to try and buy stuff that is more at the value end of the market, rather than things that and likely to rise, rather than things that have had their time. I've left this in. I'm going to update this from time to time just to show the relativity. So you'll see Sydney at the top here. Massive price increase. These charts go back to 1980. Had trouble finding good long-term charts for a while there. The data sources changed, but you can see Sydney, massive increase since COVID. Melbourne, the blue there that I'm hovering on, broken away from Sydney completely, to the point where it's now about half the value of Sydney, something I've never seen before. Ironically, Sunny Coast and Gold Coast after Sydney are the highest performers, or the highest median values, and that's reflecting people moving from Sydney and Melbourne and bringing their higher property sales, money they've just got from property sales into that market, which has increased competition. And you can see the sharp spike upwards for Gold Coast and Sunshine Coast post-COVID, as people chose to live remotely, and that remote areas were easy to work from, which is part of that story. Let me get into the budget. So the summary here is sort of 4 reforms, 4 time loans. I have put in Div 296 here. Div 296 is the super changes on the $3 million. And while there weren't any further announcements in the budget, that law was passed and it comes into effect on 1st of July, which is effectively an extra 15% tax on individual super balances, total super balances above 3 million, and effectively a 40% tax rate once you go over 10 million. So total tax rate, so think super, and I'll talk more about this in a minute, but 0 up to 2 million in retirement, 15% to 3 million, 40% above 10 million. Yeah, and it just is, and it's reasonably fair. Now they got rid of the tax on the unrealized, and they got rid of the non-indexation. We know what we're dealing with, and that is in play for next financial year. Capital gains tax reform, so grandfathered. So as I've got down the bottom there, nothing is retrospective, but it does finish. So at the moment for capital gains, you've got a 50% discount that you get on the gross gain that you make. So only 50% of the gain is included in your taxable income, and it's taxed at your marginal rates. So what will happen from 1st of July 27 is properties will be indexed, including the grandfathered ones, but also any new properties bought after budget night. So that just means if you buy a property for $1 million and inflation is 3%, the next year that cost base is $1,030,000. So if we have low inflation, cost base won't go up by as much. If we have high inflation, they will. So we don't know whether people are going to be worse off or better off. It depends on whether inflation is low or high, and it depends on what you make from your assets, whether it be property, shares, etc. The capital gains tax reforms do apply to everything. They don't apply to all structures, but they apply to all assets. And yeah, individual and trusts will be paying this. The other change to that is that instead of the tax being calculated and included in your taxable income and taxed at your marginal rates, a 30% minimum rate will apply. Now, this is clearly aimed at people retiring who plan to sell their property after retirement, and often will put money into super, or at least be selling the property when they're on a lower marginal tax rate. None of that will matter now. It will just be taxed at the 30% minimum. Now, if you're selling a property or a business or shares and you're on the highest tax rate, the 30% won't apply. Your highest tax rate will apply. So you've seen some memes and some noise in the media that effectively saying Albo's the new partner in every business, 47% tax rate applies. That would apply where we've got low inflation but a high gain. Now, the small business exemptions still apply. That's been pretty silent. No change there. So for lots of small businesses, there's still a relaxation in the amount of capital gains that's been there for years, and there's some exemptions there. So for every one of our clients that's got businesses, everyone's got investments, but and got structures. We'll be reviewing that with you all, along with your accountants, over the course of the next 12 months. There's time to look at all these things. Also, from 1st of July 27, negative gearing will be restricted to new builds only. Any negative gearing that's already established is grandfathered. Now, negative gearing never lasts forever. If you've had a negatively geared property, you'll know that eventually, as rents go up, it stops being negatively geared. So eventually, there won't be any negatively geared properties except for brand new properties, and of course, they too will fade over time. So, in theory, the design behind this is to make that more attractive to investors, to get them to build. We'll see if that happens. In 1985, negative gearing was abolished, and it was brought back in 18 months later because of the impact it had on property markets in terms of not much activity. This one's slightly different, so it's not exactly the same in that negative gearing is allowed for the new build. So let's hope that does lead to the building of more houses, and we'll see what happens there. The opposition has said they will reverse this. We'll see if that happens. They've got to get into power. And if they don't get into power at the next election, I can't see them reversing it if they got into power at an election after that, but who knows? Keep in mind, all these things are proposals at this stage, so they're not legislated. They're looking to rush through some of them. They are seeking some industry input on the CGT reforms, particularly for small businesses and startups. So we'll see what happens there. But I suspect we're going to see the other stuff rushed through. Not sure why they're rushing it when it doesn't come into action until 1st of July 27 and 1st of July 28. But if you've been watching the news, I think it's rather uncomfortable for Albo and Chalmers at the moment answering questions on this, and they'd like to have it in and buried, and then amazing how quick people forget. So the fourth leg of the big changes was trust minimum tax coming in from the 1st of July 28. A 30% minimum tax will apply on discretionary trusts. So that's things like family trusts, which many of you have. We'll be reviewing all of those. It doesn't affect some people at all. For others, it affects at the margin. So people that might have kids at university that they can distribute 20, 25,000 through and not pay any tax, that'll now be taxed at 30%. So that will hurt, but for most people distributing those sorts of amounts, it's not huge. The challenge for all of us, though, is we've set up things banking on the current rules, and now they're being changed. So we will have to review that. Where it really affects it, the 30% tax will get a credit for the eventual the person that receives those transfers. It won't be refundable, and it also won't apply to companies. So you're going to see a double taxation effectively on trust distributions to bucket companies or beneficiary companies or investment companies, whatever you choose to call it. So that will pretty much wipe out the use of the bucket company in that way. There'll be other ways suggested, and the best tax brains in Australia are already on that. It's also our favourite game is to make sure you don't have to pay one tax more than you're legally required. And we do have the ability to restructure trusts in the lead up to for the next 3 years. So for some people, we've already seen that might be able to put them in a better position by restructuring. So we've already seen a couple of clients that are going to be in a way better position by restructuring. We'll see. I've pretty much talked through those. So 50% discount goes to indexation, 30% minimum tax rate. Individuals, discretionary trusts are all caught up by this, and it's shares as well as property, as well as businesses, any asset. Excluded super continues to be king, so super's excluded from those changes. Companies are excluded. They were already excluded, so you're taxed in a company on gains. There's no specific capital gains tax in a company. You're taxed at either of the 25 or 30% rate, depending on the type of company you're in, so there's no change to that. And fixed trusts are excluded. The one thing that is of concern in this is deceased estates or testamentary trusts. They've excluded fixed testamentary trusts, but we don't really see many, if any, fixed testamentary trusts. What we see is discretionary. That's where your kids will inherit, and they've got the ability to to stream income to themselves or their kids, your grandkids, and that is quite tax advantageous at the moment. That tax advantage will disappear if this goes ahead. So it's quite concerning. It's effectively a tax, and is absolutely chasing those with money who leave funds in testamentary trust. So we'll have to watch that space as well, and we'll also need to review all wills to see if there's a better way of doing that. Super's the king out of all this. So if you look at, for 30% tax rate is now applying to trusts. Anything above 45,000 of taxable income gets 30%. Super, while it's being accumulated, capital gains 10% instead of the 30% for the others. And once you're in pension phase, 0%. So super stands out as the survivor of tax effective investing, hopefully for a long time, but at least for now, compared to the others. And once again, negative gearing, still deductible for new bills after 1st of July 27, still applies for anything bought before 12th of May 26, and anything bought after the budget is quarantined. And effectively what that means is if you make a loss, you can still negatively gear a property. You just won't get the tax benefit from it. You would carry forward the losses and they'll eventually be offset against the gain. There's some discrepancies in that. Effectively, inflation, they're counting inflation. You'll only pay gains above inflation, but for losses, it will be below the actual rate, not the inflated rate. So if you buy something for $1 million, and over 10 years, inflation takes the cost base to 1.2 million, and you sell it for 1.4, you'll have 200,000 of taxable. But if you sell it for 1.1, that will not be a loss. So even though it's below the $1.2 million inflated cost base, so they've got inflation on the upside, but not on the downside, which is a bit mean as well. 1.1 million people have a negative gearing, so they're not affected straight away. Of course, their properties will stop being negatively geared somewhere in the next 5 to 6 years as rents go up. So only the purpose, the trust stuff, I've talked about, and as I said, the concern there is for people that have been streaming income to low income payers. So might have one spouse running a business, one not working, and they can distribute small amounts to non-working spouses and pick up low tax rates. Anyone who's distributing more than 45,000 from a trust is not affected here because the 30% rate would be in anyway. So it's for people that are distributing small amounts. So it's a fallacy that this is affecting the super rich. It's only affecting the middle class, middle people who are distributing small amounts to their partners or their kids of less than 30,000. And it doesn't land until and for 2 full years before that lands. So there's time to review there, which we will be doing with everyone. And just a reminder, and to finish up with the Div 296, so up to 2 million in pension mode, 0, between 2 million and 3 million, 15%, in terms of the tax above 3 million, add another 15%, effectively 30%, which now you'll start to see these rates coming together. We've got 30% on trust, 30% on companies, 30% on super above 3 million. So there's no point pulling excesses above 3 million out and putting it into a trust or a company because it's also going to be taxed at 30%. I do like that in terms of it's less reasons to shuffle money around. So that bit is consistent. And I do like the fact that they've preserved the super side. So we'll cross our fingers that holds for a long, long time. And above 10 million, an extra 25% in total, taking the effective tax rate to 40%. I don't think there's too many people that argue against that. Of course, if you've got, and we do have some clients that are into that, but yeah, once again, it's very hard to get any lower than that. You may see some people now pulling some money out of super, putting it into companies where you get a 30% tax rate and franking credits. But there's a lot to be reviewed when we sit down and look at your stuff, not only the tax rates, but asset protection, estate planning. So all of that will be reviewed over the course of the year. There's no rush to do anything unless you've got decisions about assets coming up. So happy to talk in the meantime, but we will be talking in detail to you all as you come in for your reviews. So just wrapping up, slightly longer there, and hopefully not too much longer, as I just updated for the budget, but just as always in the summary, all investing best done as part of a real plan with your goals driving the whole plan, and your goals based on what's important to you. Portfolio designed to meet those goals, long-term view, all the boring stuff, diversification, asset allocation, liquidity, exciting life and boring money for us. We keep showing you the ways that the people that chase exciting money often get smashed, and we've seen more of that of late as well. Low cost indexing, as I showed again, beats 80 to 90% of fund managers over the long run. So it's a high probability strategy. Once again, boring, but highly effective. We protect against the short-term volatility because there are only three ways to lose money. One of those is panicking and selling. So we protect against that with reserves and dollar cost averaging. And that's it for another month. It's a big month for me. My daughter Laura, who some of you have met, she's been part of the business for most of the last 10 years, gets married on Friday. And I'm heading for Europe the day after that. So I'll be away, contactable for emergencies, but I leave, as always, my wonderful team who we've shaped to continue long beyond me. I'll keep doing these things for as long as I can, but less and less of the frontline advice. And we've built a really good team to continue on with that. So until next month, and you'll hear my voice from somewhere in Italy, I think. I'll be coming to you from next time. I'll be dialing into the investment committee meeting from Venice, and shortly after be reporting to you guys. So yeah, have a great month. Hopefully you're somewhere where the sun's shining, not good old Noosa where we're seeing lots of rain at the moment. But until next time, Rob McGregor signing out.